More on what we saw in our Friday market today with Doug Flynn from Flynn Zito Capital Management joins us along with Paul Aversano from Alvarez and Marcel. And it's always good to see both of you gentlemen. I want to talk a little about the kind of geopolitics, Paul. We see the market pulled back just a little bit today. And as Jerry Willis rightly points out, cause and effect is always difficult on a day like this. But we had the new Iran sanctions announced. And what I heard thrown around after that was that indirectly some Chinese companies might be impacted just ahead of a China deal being announced next week because they've continued, maybe skirting previous sanctions, to work with Iran. So what would you say about the relationship, Paul, between those two countries and what it all means for investors?
Well, I think, listen, crossing over 29,000 today was certainly exciting. I think in the short term, we could possibly even hit 30,000. I think the two things I would point out that people need to be aware of is, number one, we should always be taking a long-term view when it comes to looking at the markets. And more importantly, we know the markets don't like uncertainty. And going into this year, there's certainly a lot of uncertainty. I think most recently, Iran, this phase one China deal, I think the details still need to be worked out, and there's a long way to go, despite the fact that it's being signed next week. But, there's a lot of, as we get towards a phase two. And I think there's a lot of other geopolitical risks, not just Iran and China. North Korea is still out there. Russia is still out there. So there's a lot of things, from an uncertainty standpoint, geopolitically, that could really impact the market.
And all of that said, Doug, 37 trading days ago, I believe, is when we were at 28,000. So we didn't stay above 29 today. Sometimes these round numbers, especially in the Dow, aren't that important anyway. But what would you say about the momentum in the market?
Yeah, it's interesting. If you look at from December, we're up about 5%, and actually from about 3 months ago, the market's up about 13%, with like financials and technology up over 15% in the last 3 months. So when you have a move like that, although 29,000 is a nice, somewhat round number, we all really want 30,000, which we're only 3.5% away from. So I think when you have a move like that over a short period of time, that's a big move. That's sometimes more than your annual gain in just a couple of months. So it doesn't surprise me that a little bit of this coming off a little bit here is very normal. I would actually like to see a much bigger dip in the short term so we could put some cash to work, because that's where the opportunity is.
All right, 10 straight years of gains. The U.S. economy adding 145,000 jobs in December, falling short of expectations. However, the jobless rate is still at 3.5%. That is a 50-year low. Fox Business's Edward Lawrence is live in Washington with all the glorious details. Edward.
Yeah, Melissa. First, the first jobs report announced this decade. Women passed men holding jobs for the first time since 2010 in non-farm payrolls. Now, 50.04% of the labor force. As you said, in December, 145,000 jobs added. The unemployment rate staying at 3.5%, tying that record low. White House economic advisor Larry Kudlow says, look at the wage increases for men and women, because he says this report still shows solid fundamentals in the economy.
The bottom half of the population has seen an increase of 47% in their household net worth. The top 1% has seen an increase of 13%, because that's the sign of an economy that's been restructured and reopened and has more dynamism.
And average hourly wages increased 2.9% in 2019. The last time that percentage fell under 3% was July of 2018. Now, this indicates muted inflation pressures. Prices are not drastically rising. Going into the first meeting for the Federal Reserve this decade, inflation will be in focus. In my exclusive interview with Minneapolis Federal Reserve President Neel Kashkari, he says inflation is his trigger, and that's important because he's a voting member that sets rates this year.
And right now, I'm comfortable with pausing interest rates to see how the economy evolves. If inflation expectations continue to slip or the economy continues to weaken, I probably will advocate for further rate cuts, but I'm comfortable where we are right now.
And we have heard clear up uncertainty like ratifying USMCA and signing a good phase one trade deal with China. It could boost the weaker business investment, especially in manufacturing and construction. Construction, for example, adding 20,000 jobs in December, but in all of 2019, adding 151,000 jobs. That doubled, though, in 2018. So, Melissa, there is room for growth in this economy as we go through 2020. Back to you.
Edward, thank you. All right, Paul and Doug are back. Paul, what do you think about this? I mean, it looks like there's still room to run here. I saw a study from Goldman Sachs recently that was crunching the numbers, saying that salaries at the bottom are growing twice as fast as salaries at the top. So there's good news even inside all of these numbers in terms of the wage gap closing between rich and poor.
Right. I think most of the commentary you hear, this is more of a good message as far as the job report goes. But most of the commentary you hear is looking back historically over the last year, and obviously by any measure, the economy and the jobs report has been very strong. I think, however, though, I'm going to take a little bit of a bearish stance looking forward. What concerns me most is that we're at the end of the cycle, we're in a historically low interest rate environment, and Deutsche Bank has come out and reported that half of the U.S. population spends more than their income. And that is what scares me a little bit because, historically, this market has been driven by consumer spending. How long can that continue? Yeah. So in the short term, I think there's more room to run. Over the medium to longer term, I'm a little more bearish.
So, Doug, I'm going to take the other side of that bet because I think that we have seen the economy and the market held back by the fact that we are trying to do all these trade deals. And so there is an artificial boost coming when the president makes a deal. I mean, whether it's getting the USMCA into effect or it is making some kind of a deal with China or making a deal in the UK on the heels of whatever happens with Brexit. I mean, it just seems like that's going to be a boost where normally I would think Paul would be right. We would be at the end of this cycle. But we have this other extraneous thing that's going to happen and breathe new life. What do you think?
I kind of agree. I think the unemployment rate is going to tick down towards the end of the year, but there's a couple things that we look at deeper than just the month-to-month changes on these numbers. And one of them is the thing, the U6, which includes discouraged workers and part-timers looking for full-time. That is at its highest level in 25 years. And also the labor force participation rate of the prime workers, age 25 to 54, is is the highest in 10 years. So I think there are better numbers behind just this headline number here that bode well when these other things come online, and you should see some of that in turn turn into a lower unemployment rate, even though month to month it may or may not hit the number that we're all forecasting.
Yeah, U6 looked really good in there. Paul and Doug, thanks to both of you. Great commentary, guys.
Very good.
Appreciate it.